Chapter 6. Capital Flow. All rational holders of capital strive to invest their money into the highest yielding asset among all possible asset classes, subject to their acceptable risk appetite. In other words, we can expect the available capital will be flowing from lower yielding to higher yielding assets, everything being equal. Rational investors require different yields from different assets based on the associated risk. U.S. government bonds are called risk-free investments, and all other assets are adjusted from this baseline. For example, investors of corporate bonds demand higher yields from U.S. sovereign bonds because of higher risk. A rational investor will always choose a U.S. sovereign bond over a corporate bond if yields are similar. That's why corporations need to offer a higher yield to investors to sell their bonds. The difference between the two yields is called credit spread. Liquid funds tend to flow from one market to another, especially between bonds and stocks. The capital flow between these two components of capital markets is rapid and frequent. A portion of this flow is involuntary when mutual funds and other institutions do their mandatory rebalancing. However, significant amounts are willingly transferred from one market to another, searching for higher yields. The concept of money. One fundamental concept to understand is that money is not created or destroyed by investors. All transactions are barter between two asset classes if you consider cash as an asset class. Suppose you have cash, and you exchange this cash for a stock. Essentially, you have bartered your money with the seller of that stock. Now you have the shares, and the seller has the cash. You see, this transaction created no new money, only exchanged it between hands. In our current monetary system, cash acts as a scale or a standard with which all other asset classes are measured. Money that you and I know is created by central banks. They have the authority to increase or reduce the money available. Popular tools to inject new money into the system are either reducing the interest rate or buying assets. Every new dollar printed by the central bank makes current dollars a little less valuable. As the value of cash goes down, all other asset classes go up, because cash is the baseline or the standard scale to value all other assets. Suppose the U.S. government buys $1 billion of assets. It means $1 billion new dollars are available. Rational investors will invest these new dollars into investments of their choice. Suppose all of these new dollars go to the stock market, as all rational investors decided that stocks are the most advantageous market at this moment. Suppose with this new money, 0.1% of all shares were bought, and the market price went up by about 2%. However, the total stock market valuation will be increased by many billions. This 2% increase will be applied to all 100% of the stocks, although only 0.1% of the stocks were sold at this price. Let's take an example. Suppose ABC Company has a total of 1,000 shares outstanding, and the previous market price was 100. The total market capitalization of this company was 100,000. 0.1% of 1,000 shares is one share, and with new money, only one share of ABC Company was bought at 102. Now the total capitalization of ABC Company is 102,000, about $2,000 more despite only $102 being spent. About 20-fold increase. That's why during a financial crisis or in a recession, the government tries to increase the available money as it pushes asset valuation up. How the capital flows. Capital routinely flows between the stock market and bond market. In theory, these two markets should have an inverse relationship. If one goes down, the other goes up. However, this only holds in normal market circumstances. In challenging times, investors rush to convert their risk assets into cash, so the capital market's total money is somewhat less than usual. This apparent money shortage pushes the prices of both stocks and bonds down. It is impossible to say whether an asset class valuation is cheap or expensive in isolation. The valuation of an asset is relative to the valuations of all other assets. For example, if the S&P 500 PE is 20, it means the yield is 5%. If the 10-year bond is paying 7%, the stocks are expensive, and the capital will flow to the bonds. Conversely, If the 10-year bond is paying 2%, rational investors will allocate more capital to stocks. Capital should and will flow from lower to higher yielding markets, everything else being equal. Conversely, money should flow from high risk to low risk markets, everything else being equal. Investors try to find an appropriate trade-off between risk and yield when making decisions for capital allocation. Relationship between the yield of bonds and stocks. It is wise to routinely compare the S&P 500 yield with the prevailing yield of a long-term bond. I use the 30-year U.S. government bond yield. Given the riskier nature of stocks, the overall market yield should be considerably higher than risk-free bonds. Yields of bonds of different maturity and risk are easily available on the internet. You can calculate the yield of stocks by dividing 100 by the PE ratio. Yield equals 100 divided by PE. If stocks are not offering the extra yield to compensate for the added risk, then the stock market is expensive and will correct itself sooner or later. However, as Howard Marks said, prices are too high is far from synonymous with the next move will be downward. It may take some time, but capital will eventually flow to the most logical place. I use the yields of a 30-year U.S. government bond and S&P 500 to evaluate which capital market is more advantageous. This comparison gives me an idea of possible capital flow. This combination works for me because I am a long-term investor. I have no desire to take excessive risk to double my money in a couple of months. Your risk may be different than mine, and this 30-year/S&P 500 combination may not be suitable for you. Your holding period could be different from a long-term investor. You may be a swing trader or maybe a day trader. You will have to adjust the formula as per your needs or devise a different recipe that suits you. For example, current PE can be swapped with forward PE or Shiller PE, long-term PE. 30-year bond yield can be exchanged with 20-year or 10-year bond yield. It is not vital what PE or bond yield you use. However, you must understand the relationship between risks and returns. Any formula of gauging the relationship between yields of bonds and stocks should be taken as a scale just to put things in numbers. A human eye can easily differentiate between a large object and a small object without any help from scales of cubic feet or cubic meters. Still, we develop these scales to measure. These scales give us perspective and give us measurable differences. If you have a measuring scale, then you can keep track, and you can identify opportunities. Capital loves yield, and it flows in the direction of higher profits. This flow will be slower for illiquid assets, but could be almost instant between highly liquid assets. People generally don't sell houses to invest in stocks, but they will sell bonds to take a position in shares if they believe stocks will provide higher yield adjusted with risk appetite. If you are an investor in the capital market, you need to keep an eye on the relationship of yields between bonds and stocks. The allocation mandate of mutual funds creates opportunities. Being a long-term investor doesn't mean that you must allocate capital with a predefined ratio between stocks and bonds. Different periods demand different capital allocation. However, a large portion of invested capital is a slave of mandatory allocation. Most mutual funds and insurance companies must rebalance their capital to a predefined allocation ratio, regardless of risk and yield. For example, at the height of the dot-com bubble, stocks were offering extremely low yields. In times like these, capital should be taken away from shares. On the other hand, after years of no growth in price, in 1982, yields of stocks were extraordinarily high and demanded a higher allocation of capital in shares. These two periods required two different ratios of capital allocation between stocks and bonds. But mutual funds with mandatory allocation cannot adjust. This inability to adapt offers a massive opportunity for an intelligent investor. As a long-term investor, keeping an eye on this relationship keeps my emotions at bay. It is a substantial psychological help. It helps me to navigate through periods of market noise. I usually don't trade in or trade out based on market prices. In difficult times, I lean back to this ratio and calm myself down. Market downturn and stock yields. When prices are going down in a significant market meltdown, the yield is getting better. Soon, a big help will arrive in the form of mandatory rebalancing. As the market will find its bottom, technical indicators that are flashing red will turn green, and then another wave of support will come in as technical investors. Value investors will find value in several stocks. This transition will happen until the ratio between stocks and bonds yield returns to an average level. However, things will not stop at this point. Momentum investors will see this upside move and start buying and pushing the ratio to the other side. Then the speculators will come and try to squeeze the last drops from this market rally. That's how the market works, and it will always work like this. Economic conditions may differ from periods to periods, but human psychology is embedded among us and will not change. Markets work in cycles, short-term and long-term cycles. Stocks frequently go down from their all-time highs. Every couple of months, stocks go down by 3 to 5 percentage points. On average, one 10% correction happens every year. The market goes down by 20% every 3 to 5 years, and a significant bear market happens every 10 years or so. You will never know when a 3% decline turns into a 50% plus bear market, and it is not essential to know. What you do in these difficult times is far more critical. In Tony Robbins' words, the winter is coming, and you need to be prepared for it. You need to have a plan. You can't predict. You can prepare. Howard Marks. Every all-time high of the stock market proves that the market has eventually recovered from all downturns, 100% of the time. This strategy is the only one that worked every time without a single failure for centuries. Try to build your investment plan around a strategy that has worked every single time. Price discovery. Recently, a discussion topic emerged related to price discovery in markets. It was argued that a significant rise of passive investment eroded the market's ability to find correct asset prices. People are investing through their passive investment vehicles like indexed mutual funds, and money is flowing and being invested in assets, totally disregarding the fundamentals of that asset. On the contrary, the more a security rises in terms of market price, the more it will attract new money because of its relative weight in the index. For example, if ABC Company was 1% of the index, but due to a sudden price increase, it is now 2% of the same index. In this situation, this stock will attract twice the amount of new money. This is because its relative size in the index has doubled as compared to other securities, regardless of whether the fundamentals of its stock have changed or not. I can see the point in this argument and can agree with it for a short-term period. However, over the long term, prices are attached to relevant yields, and money will eventually flow to better performing stocks, not in terms of prices, but in terms of the actual business. The rise of the passive investment may skew the prices for a while, but eventually, prices will be corrected by the market forces. If a business is not performing, no matter what, people will relate its price to its earnings and eventually move to higher yielding stocks. The whole idea of passive investment is to disregard short-term market noises. So advocates of passive investments will say that who cares if the market is skewed or overvalued for a short period. It will eventually correct itself, as it always does. Chapter takeaways. Capital must flow from low yield to high yield, and from high risk to low risk, everything else being equal. Activities of capital markets do not create or abolish money. Governments do. Capital efficiently and frequently flows between bonds and stocks. It pays to keep an eye on yields offered by these markets. Mandatory allocation of capital between bonds and stocks by mutual funds creates tremendous short-term opportunities for investors. The stock market, as a whole, has and will recover from every downturn.